All right. Good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Tuesday, the 11th of 2019. What I'm going to go over today is a rather important, but actually, let's make sure you can hear me. If you can hear me, please go ahead and type in that you can hear me. Let me know that you can hear me. All righty, there we go. Good. Okay, what I want to talk about today is understanding the process. And of course, I'm talking about collar trading. So let me throw a couple questions out there. What is the purpose of collar trading? What is the purpose of collar trading? Okay, got a couple answers that came in. One of them says to make up downward movement, to create risk-free trades. Now, both of those are right, both of those are wrong. So let me ask two other questions that might answer both of those. Will you make up every single penny on the way down when you collar trade? I see some yeses, I need some no's. So the correct answer is it depends. If you are willing to make up every single penny, you've capped yourself to the upside, and you won't make very much to the upside, and you will have to run your stock position without protection at certain times. On the flip side, if you're not willing to make every penny on the way down, then you're going to open yourself up to some significant gains to the upside. So simple purpose of collar trading is to make up some of the downward movement. Because, there you go, anything you make up on the way down is profit as stocks come back and can be transferred into new stock ownership. If your stock goes down 10%, you can choose just to lower your cost basis by 10%, or why not allow yourself 10% upwards movement? So let's take a look at the Dow. Here's a chart of the Dow. We went down from 27K down to 21.7K. That tells me that chances are we had some pretty significant downward movement. If you were to look at that chart, how cool or how important would it be to have the ability to make up some of the downward movement on that stock, and then to convert that maybe down at 21? You're probably not going to get it all at 21.7. Maybe you're going to get it closer to 22. But how cool would it be to be able to make up some of that downward movement and then convert it to more shares as it comes up from 22.7, maybe up to 24.25? Wouldn't it be better to be able to try to add more shares down below to give yourself more opportunity as things come up. It's an interesting thought. We had a pretty big downward movement. And I'm not saying you catch everything on the way down. It would be pretty foolish to think that you would. It really would. But if you could make up some of that downward movement, how cool would it be to create more shares so as things come back, you can make up maybe 10% more on the way up? I think it would be pretty important if I could make up half of this, pick up 20% more shares to be at a break even right here. That's the whole thought process behind collar trading. You've got to understand the process. Collar trading protects you. I could tell you collar trading protects you from, hit my computer screen. Sorry about that. Protects you from a 2008 type crash in the market. Now, I've heard people talk about, well, if we have that again, I'm just getting out. With all due respect, I'm going to tell you that won't happen. Because if you had noticed, you would have gotten out in 2008. You would have gotten out in 2000. It's not going to happen because you think you're going to do it. Past history is not a guarantee of future results, but it doesn't show you a really common or a really good way that you're just getting out. So just to give you a simple idea, here's understanding the process. To make up to make anything you make up on the way down, to create profits as things come back, to create new stock ownership, I could put in here dollar cost averaging without asking for more money. Collar trading protects you from a 2008 type crash, and most importantly, in my opinion, this is just my opinion, I don't have to worry about ever losing half my portfolio. I can sleep at night, and I'd much rather sleep at night than worry about what's happening. With that said, last year was my toughest year. And last year turned me into a life coach, where it's just not about making money in the stock market. It's about creating wealth for your family, protecting your family. It's understanding how death affects a family. It's finding ways to be what people need on a more constant basis in regards to understanding what their what their money is doing in the stock market. Life is not easy. And neither is the stock market. It's tempting at times just to throw people into an index fund and say, you're good. But when the market hasn't doubled itself since 2000, I scratch my head and wonder what the hell people are thinking and why they would ever do that to their money or themselves. What we do at Hurley Investments is a process. And the process doesn't have a timetable. But the process does have a way to protect your money and to give you ample opportunity to add significant shares like a Warren Buffett would to be profitable at the end of your investment period. It's as simple as that. If you were to ask me where we're going to end this week, I'm probably going to tell you we're going lower. I want to be more optimistic, but I do think we're going lower. I'm saying that where we're still holding on to bullish markets. Yes, we had a little bit of a pullback. Yes, we have our MACD closing. Institutional money has not put so much in, but charts usually look like this, right? Big institutions gain back in at the beginning of the year, and then we run it for a while. Not wildly bullish, but we're still bullish on the Dow. If I was to bring up the S&P 500, it's a mirror image. Looks exactly the same. Still bullish. And obviously on the NASDAQ, slightly more bullish, but not by much. We're kind of in a pause or a breather. We have a bit of a short-term support level there at the end of January, a base that was trying to form, trying to get to our next leg higher, but we're having a problem getting above that 200-day simple moving average on the NASDAQ. If I was to bring this back up to the S&P 500, we bounced off the 200 there, and we're actually holding the 200 on the Dow. Probably give kudos and credit there to Boeing. But our charts are still showing us bullishness in the stock market. With that said, where are we going to end February? I'm going to tell you we're going to be down 2%. Reasons why: we're running into two main risks in our stock market. You should pay pretty good attention to them. There might be three. Anyone know what those risks are? I know you guys would say that one. What are the two other risks? What other risks are affecting our stock market as we're running into the month of February? China trade deals on the 31st, or on the 1st. Maybe it's March 15th. I can't remember. It's March 1st or March 15th. I would probably tell you it's March 1st. And of course, we have a end of week government shutdown. And we still have a Brexit in the works. More risk to the downside than missing to the upside. That's what I see right now. If we keep going, earnings, not too exciting. We have Lowe's and Chegg. Tuesday tap, which I believe is Molson Coors, Activision, Akamai, Denny's, Trip, Under Armour. I'm paying particular attention to Under Armour as I have quite a few shares of it. In fact, if I can take you on down, where's my Under Armour? Ford Earnings Press and Stale revenue estimates can see lower revisions. If they beat on revenues tomorrow, they should take off nicely. It'll be interesting to see, though. They've made some changes that, in my opinion, are moral changes within the company. It'll be pretty interesting to see what happens to it. If we look at revenue estimates in their chart, those are yearly estimates. The 19, 5.394. They're still making good money. I guess it comes to the point if their higher valuations warrant where they're going to go. As I'm looking at what I want to tell you, I plan that they're going to go higher. Pay attention. They should do awful good coming into this month. Earnings otherwise, AIG on Wednesday, Fossil on Wednesday, New Skin, Duke Energy, Coke on Thursday, Nvidia on Thursday, Deere, PepsiCo, Kraft Heinz on Friday. Let's make sure I'm giving you the right stuff. Yes, that we are. With that said, I did not fill in the economic reports. Today we had no economic reports. Tomorrow we have the JOLTS. And we have the NFIB Small Business Index. Those will come up on, those are Tuesday's reports. So let me take those and cut those out. Get those properly placed on Tuesday. Wednesday, we start to go into a slew of reports. But Wednesday is the MBA housing. We have the CPI, we have the core CPI, and we also have the Treasury budget. Usually the Treasury budget is not important, but we're looking more at the Treasury budget here as of recent to see if we are decreasing the budget or if they're rolling those Treasury bonds over to prop up our Treasury market. Thursday, PPI, core PPI. We also have retail, can't spell, retail and retail X transportation, which will be rather interesting. Transportation. And I also believe we have business inventories. To finish off our week, better spell that all the way out or it's going to get messed up. There we go. Friday. Friday is an options expiration, but more importantly, we have the import, export, capacity utilization. We also have industrial production. Now, these are going to be typically lower because we're getting done or out of the Christmas month, so we're not going to have some of these higher numbers that we're used to. It is a seasonal thing. Empire Manufacturing. We also have the Michigan Sentiment. And don't forget options expiration. It's your weekly one, not the monthly. So you know what? I'm just going to put that out. Let's make sure I'm correct here. Nope, it is the monthly options expiration. So all of your monthly February will expire. For this week internationally, I should throw Monday back in there as well. So we have Wednesday, China, merchandise trade, balance. On Thursday, we have inflation numbers from China, which have not been doing good historically. Obviously, we're paying extra attention to China with the Chinese trade deal. As we go through earnings this week on Marathon Oil, earnings on Under Armour. Baidu was supposed to have it, but looks like they're now out to the 21st. I had a couple interesting articles here. Warren Buffett says this is why he did not to get rich on Wall Street. And pretty important. He's basically telling you, do your own homework. Stop watching and believing what you see on TV. Do your own homework. When you do your own homework, it's more likely to give you an understanding of what you're in and why. As we go through, Cramer's going to reveal brutal truth about China. I'll be honest with you. I thought it was pretty interesting that China became so important. Now, if you have some international stocks, Disney would be considered international. Baidu, Starbucks, Nike, Under Armour even sells out there. It's surprising when you do your homework how many stocks have an international clients, people that'll buy their products internationally. Any tensions here are going to obviously slow down their guidance statements in the future. It should lower revenue. It should lower earnings per share. Understand and expect some of these to happen. What I'm going to tell you is not priced in is an extension maybe of the tariffs, some good news or some type of Chinese trade deal. Our stock market will rocket 1,000 points to the upside. It is not banked in. It has not been for a while. Pretty important. Did Netflix set the stage for Disney? If you're trading Disney, spend some time watching and looking at how important content is king. A lot of the cost, the ridiculous cost on Netflix, the cost that makes it a fundamentally unsound position, Disney already has covered because Disney already has the content built into their model. The way that they create their movies is part of their expenses already. So to now place it on a platform will give them enhanced profitability or even better margins when you compare them to all of the other content providers. This is going to go through, obviously, Netflix. This will go through, who's the big one I'm not remembering? Warner Brothers and what they're trying to do. In all honesty, I think Warner Brothers said it best here a couple days ago. It's not about beating Netflix or Disney. It's just being an option. I'll be honest with you. When Disney's up and running, I guarantee you with having kids, with the movies that Disney's producing, I will have Disney and Netflix. It'll be another option. I will spend more money on that, and I will probably, what's another $15 a month? In all honesty, one good night of babysitting with my kids in front of the TV pays for the year's worth of Disney, in my opinion. Interesting article on Baidu. I'm really going to focus on the back end here. The conclusion. The value of the high-profile Baidu search engine alone significantly exceeds the current market capitalization of $59 billion. However, there are additional assets with a market value of at least $25 billion on the balance sheet of Baidu, including equity stakes and IQIYI and C-Trip, and excessive cash which an investor in Baidu gets for free. Autonomous driving, cloud services, and artificial intelligence projects can also become income generations in the future. A very interesting understanding of looking at Baidu and seeing it's undervalued if you're willing to do some of your own research and your own work on what you're doing or what you're investing in. Then I have the rest of that Under Armour. So with that said, I kind of whipped through it a little bit quickly tonight. It is a rather small amount, but that's obviously because I'm switching some times on you. What questions can you have? And with that said, Mary, you asked me about Ford. So the question is, why am I invested in Ford? And here's the honest reason. Because it should trade in the $22 to $27 range, 7% dividend, and cheap by valuation metrics if you understand their credit division. And most people don't. In fact, I think analysts are absolutely horrible at understanding their credit division. They should not be punished for something that generates upwards to 30% of their revenue. When in all reality, they get a little bit of a discount on the car, they collect some interest and some payments on the car, and then most of us, after 6 months, go to our local bank and get a better interest rate. They win on it. They keep it on their books for 6 months. There's such a revolving credit around the automobiles and what they have on their books as an expense. Yet it's a great moneymaker for them. They collect all the upfront fees, and some of us pay it out again, or sometimes get a zero fee, used car loan, and off we go. So, no brainer. Why I'm invested in Ford? It's cheap because I've been in it forever. I have umpteen thousands of shares of it. Gall, if I keep going at this rate, I'm going to own 10,000 shares of Ford, and it's going to produce for me, 10,000 shares at $10 would be 100,000. It'll produce $7,000 a year for me in dividends. Kind of a no-brainer. And when it's down here at this low, it only looks to be able to go higher. So it's kind of a no-brainer for me. Obviously, I've sat through it as it's lost 2/3 of its value, but it hasn't lost 2/3 of its value per anything it's doing wrong. And it's not being rewarded for what the street wanted to do in the first place. Streamline its base and make only the most, how do I say it? The single most model car that was sold last year, 1.13 million Ford F-150s. By far beat any other single model car that's out there to be made. Number one selling car for 2018. And dang it, I wish I had a new one. Okay, we kind of went through this a little bit quicker than I expected today. Are there any other questions? If not, let's call this a night. We'll call it a night. I'll get this off to Dave. We'll get it up and posted here shortly, and we'll call it a night. You guys take care. Keep looking for podcasts and more information I'm trying to push out to you. I will have a market recap for January out this evening. You guys take care. Have a good evening. And Lance, am I comfortable being an Under Armour versus Nike? So yes, and Lance, let me run through why, just to make it pretty simple. I think valuation-wise, they're both about the same. They both have similar metrics, but But if I take a look at it, Nike is trading at 83.68 with an all-time intraday high at 85.79. I've got $2.11 of upside to the highs of Nike. On the flip side, Under Armour, that we can see on this chart, has been, well, you really can't see it, but it's been as high as 52.50-ish, currently trading at 20.78. So I've got about $32 of upside opportunity on Under Armour. Yes, they're taking a beating. Yes, it's different. Yes, it's hard to sit and wait through these. But it is an opportunity. So I see a better opportunity in Under Armour at a low than I see in Nike at a high. It's that simple. Good question. All right. Any other questions you guys have? If not, guys, have a wonderful evening. I appreciate you being with me. Tomorrow morning, we're going to try at 10 o'clock nope, I'm going to change it till tomorrow night. Tomorrow night, I will have a 6 o'clock trading and market opportunity. It will most likely revolve around Under Armour, seeing which direction it goes, or trying to outguess Fossil or Marathon Oil on Wednesday. All right, guys, have an excellent evening. I will look forward to seeing you tomorrow night for our trading and adjustments opportunities. Thank you. Bye-bye.